Hello there. Welcome to Financial Accounting Info. We've got a question that we have here, a question from June 2023. This is question 5, and the question is on the statement of cash flow. The question reads, as a junior bookkeeper, you are requested by your manager to draft the following. Part 5.1, it requires us to prepare the statement of cash flow for non-traders as of 30 June 2021. And then the second part requires us to prepare note for cash received from customers. Then 5.3 also we have got note for cash paid to suppliers and employees. So remember, in our cash flow statement, we are going to start with net cash effects from operating activities. So these net cash effects from operating activities are going to require information on cash received from customers and cash paid to suppliers. So we need to prepare the notes first, so that when we find the figures for these notes, then we are going to start with them under operating activities. So if you go to our answer section and see here, we have got the statement of cash flow for the year ending 30 June 2021. So cash flow from operating activities is the first section that we are going to fill in. So under that one, we've got cash received from customers that we are going to find in note 1. And then we've got cash paid to suppliers and employees that we are going to find in note 2. So first of all, we are going to prepare the note 1 so that we find this figure. Then we prepare note 2 to find this figure. Then we just put the figures here. And we have already made a reference here that this figure is going to come from note 1. This one is going to come from note 2. So if you go down, here, you see that 5.2 now is now on the calculation of cash received from customers. So that's where we are going to start find those figures. Then we put them under operating activities. So on that one, we are going to start with the revenue figure for revenue, which we are given in the question. So we go back to our question to find out the figure that we have for revenue. Here we don't see it here. Let's try on the first page, and then we go down to check the figure that we have for revenue. Right. We have some figures that are there beneath that table. Right. We have the figure for revenue that is here. Here we are given extracts from the statement of profit or loss and other comprehensive income for the year ending 30 June 2021. So this is the figure for revenue that we have, which is 4,200,000. So we are going to input that figure, 4,200,000, in that note as an opening figure that is there, 4,200,000. So here we have got $4,200,000 dollars. Sorry, 4,200,000 rands, and then beneath that now we are supposed to add trade receivables at the beginning of the year. Then we subtract trade receivables at the end of the year. So the issue is on trade receivables. These are trade debtors. Remember, these are people or firms that we are selling goods to on credit. So when these people pay back these goods or these amounts owing for goods and services, the balance will go down. So if it's go down, it represents an inflow. So it is going to increase the figure for revenue. So that is the scenario that we are going to go through here. So the opening balance of those trade receivables, we are going to add it. So here we say add trade receivables. Add trade receivables at the beginning. At the beginning or at the start of the year. At the start of the year. And we go back to check what amount do we have for trade receivables at the beginning of the year. Right, if you come here, that's where we are going to find this figure in the list of balances that we are given there. We are seeing that trade and other receivables. This is the figure that we have. And then if you go on top there, we have got this column for 2020. That's where the year is beginning, and then we have got 2021. That's where the year is ending. So 2020 represents the start of the year. So trade and other receivables at the beginning, we have 227,500. Then at the end, we have 200,000. So we are adding 227,500 and we subtract 200,000. So we go to our other section. So here now, we are adding 227,500. Then we subtract, when we are subtracting, we less trade receivables. At the end of year. So the figure that we got there was 200,000. So here we are going to put 200,000. So remember, we are subtracting, so we can show by brackets. So having done that, now we now find the net figure here. We now find the net figure here. So right, the net figure that we are going to find is now the cash inflow for the year. Right. So if you say 4,200,000, then you subtract 4,200,000, you add 227,500, then you subtract 200,000. Here you are supposed to get 4,227,500. So this is the net figure that we are going to put there in our cash flow to 4,227,500. Right. We are seeing now cash received from customers. That's the figure that we have there. Cash received from customers. Here is 4 million. The figure that we got there was 4,227,500. Right. Then now we go to the note 2, where we are going to calculate the cash paid to suppliers. Then we go to note 2, where we are going to calculate cash paid to suppliers. Right, this is our note 2. Right, on our note 2, we are going to show revenue or income. We are going to show them as negative figures. Revenue and income, we show them as negative figures. Then expenses and payments, we are going to show them as positive figures. So let's start by the first one, which is revenue. The information that we are given in the question, all revenue and income, we going to show them as negative figures. Then all expenses and payments, we show them as positive. Then we are going to add those figures that we'll be having under that. And then the net figure is now the figure that we are looking for, that we are going to put in the cash flow. So let's start by revenue. So our revenue is this figure that we put here, which is 4,200,000. And we are saying revenue and income, we show them as negatives. Then from there, we less comprehensive income for the year. We less comprehensive income for the year. Right. So we want to see where do we have this comprehensive income in the question. Let's try to see here if we have got that figure for comprehensive income for the year. Right. You see the comprehensive income for the year. Remember, we are preparing this statement of cash flow for the year ending 2021. So our comprehensive income for the year that we are going to check there, this one is for the previous year, 120,500. So the one that we are concerned with is 383,500 for the current year. So this one is the figure that we want, 383,500. When we go back here, we have got 383,500. This one we are showing it as a positive because it's we are saying less. We said any amount that is increasing revenue, we are showing it as a negative, but any amount that is reducing revenue, we show it as a negative, sorry, as a positive. So here, when we do that, we get a net figure here. When we say negative 4,200,000 plus 383,500, we are supposed to get a negative 3,816,500. And remember, this is a negative and a bigger figure, and this one is positive but a smaller figure. So the answer that we are going to get is going to be a negative one. And that figure that we get there, we are going to call it expenses. Expenses for the year. Expenses for the year. Expenses for the year. Right. Then we go down. Right. Then we go down to other adjustments here. Here we now have other adjustments that are there. Then we are now going to look at any expenses or payments that are there in the question, and then we adjust for them. So we are going to start with interest on overdrafts. We are going to start with interest on overdrafts. So we go back to our question to find out the figure that we have for interest on overdrafts. Let's try to go down, check the figure that we have there. Right. So on that one, where we've got the extract from the statement of profit or loss and other comprehensive income for the year ending 30 June 2021, we have got an interest on overdraft, which is 1,200. We also have an interest on mortgage bond of 1,200. 1,200 is for interest on bank overdraft. Then interest on mortgage bond is 166,500. Then the interest on a fixed deposit is not given. But according to the information that we are given, it means that this one, interest on overdrafts, this one is a payment. So we are going to show it as a positive. Remember, payments and expenses, we said they are going to be shown as positives. And this one, interest on mortgage bond, also is a payment. So we are going to show it as a positive again. But this one, interest on fixed deposit, is an income. So we are going to show it as a negative. So we are going to see how we can calculate this one, because here is given as a question mark. We are not given the figure. But basically, let's go and put this one, interest on overdraft and interest on mortgage bond. So we go to the answer section. We have got interest on overdraft, and we are saying the figure is 1,200. 1,200. We show it as a positive, and then we go to interest. Interest on mortgage bond. Interest on mortgage bond is 166,500. Then the next one was interest on fixed deposit. And this one we said is income. But we are not given that figure. I think we are going to show the calculation down, how to calculate it. So we look for the information that we have concerning how to calculate that one. Let's try to look on this page if we have got anything concerning interest on fixed deposits. Right. Here, if you come here on note 2, fixed deposit of Allied Bank, 18%. So this is the interest in brackets, 18%, and the fixed deposit is 25,000. We are saying 25,000 here. But this 25,000, we are seeing that in 2020 it wasn't there. So we need to know when this deposit was made, so that we can see if it stayed the whole year. If it stayed the whole year, we are just going to say 18% times 25,000. But remember, this 18% is per annum. So we need to know for how many months we had this fixed deposit in the business. So we go down again to check if we've got information that is telling us about that interest on deposits. Here we don't have anything in terms of when we received that, interest on deposit was made. We go again on the next page to check any instruction concerning that. Right. If you come here, here it's saying interest on fixed deposit. The investment was made on 31/12/2020, and the year is ending on 30 June 2021. So the investment was made at the end of December. So we have let's look at how many months were there. We have got January, February, March, April, May, June. June is the year end. So that we count how many months was this investment there in the business. 1, 2, 3, 4, 5, 6. So we have got 6/12. So this investment was there for 6/12 as a period. So we are going to say 18%, 0.18. Then we multiply by 25,000 the interest. Then we scale it down to 6 months. So in brackets here, we are going to say 0.18. This is 18%. The fixed deposit, we multiply by 25,000. It was 25,000 deposit. Then we multiply by 6/12, the period that it stayed. So if you do that, you get 2,250. And remember, we said this is income, and we are going to show it as a negative figure. So we go down again to check the next one. Right, the next one is depreciation. The next one is depreciation. So let's go and check where we have the instruction in terms of calculating this depreciation. Right, this is where we have got the information of the non-current assets that we have. We've got property, plant, and equipment note that is there. And then we are given the column for cost price, accumulated depreciation, and gross carrying amount. And then this we have a period of for the year 2021 and for the year 2020. So what we need to do there, we need to see what they are saying about the calculation of that. We've got that note that is here. A vehicle has been sold on 30 June 2021 for 132,000. The cost price of this vehicle was 227,500, and the net carrying amount amounted to 120,000. So we are seeing that you only have one vehicle which was sold, so it's going to affect the depreciation for vehicles. But for equipment, there was no equipment which was disposed, and no equipment was purchased. So it's easy to calculate when it's like that. We can just take the accumulated depreciation for the current year, and then we subtract the accumulated depreciation for the previous year. Then we get the depreciation that we are supposed to charge for equipment. So basically, we are going to do that for equipment. Let's do this for equipment. Depreciation for equipment. We are going to say accumulated depreciation. This was 2020 and this was 2021. So for 2021, the accumulated depreciation for equipment, let's try to see there. The accumulated depreciation for equipment. Equipment is the second row here and here. In 2021, it was 267,000. So 267,500. Then we subtract for 2020, which is 172,500. Then we find the depreciation for equipment. So we are going to say 267. 267. So this calculation applies only when there's no purchase or disposal of that non-current asset. Then you subtract 172. Right. So when you do that, when you calculate that, you get 95,000. So this is depreciation for the year for equipment. Now we have got another one, which is vehicles. When we find for vehicles, we add together to get the total for depreciation for all the non-current assets. So if you come to vehicles, there we see that vehicles had a disposal that was there. So how can we basically find depreciation for the year? We can use the calculation for the accumulated depreciation account. Remember, in the accumulated depreciation account, let's just give a breakdown in terms of the accumulated depreciation account of a non-current asset. The balance BD at the beginning will be here. Balance BD at the beginning will be on the credit side. And then the balance CD at the end will be, balance at the end will be here on the debit side. And then the depreciation for the year, depreciation for the year will be on the credit side. And then we have got a non-current asset that was disposed there. Its accumulated depreciation up to the day it was disposed is will come to the debit side, and it goes to the disposal account. So this is the scenario that we have. So basically, that's what we are going to do there, so that we find the depreciation for that vehicles. So if we do that according to the that T account that we have prepared there, we see that balance B is the one that is at the beginning for vehicles is this one, 366,000. So it comes there on the credit side. Then the accumulated depreciation at the end is the one that we have for 2021 above there, 498,000. We are seeing it here, 498,000. So we come here, we are going to say 498,000. Remember, this one is the CD at the end, 498,000. And then the accumulated depreciation of the non-current asset that was disposed, you can find it from the information that we are having here. Remember, we've got information that is telling us here that a vehicle has been sold on 30 June 2021 for 132,000. The cost price of this vehicle was 227,500, and the net carrying amount was 120,000. So here you can find this the figure of accumulated depreciation for this non-current asset by saying, you know, the formula that that says costs minus accumulated depreciation, we get the carrying value. So according to the information that we have got the costs, which is 227,500, and then we've got the carrying value, which is 120,000. So we want the accumulated depreciation. So if you make accumulated depreciation subject to the formula there, it becomes carrying value. It becomes carrying value becomes negative there. It becomes cost minus carrying value. So that's what we are going to do there. So basically what we are going to do, we are going to say the cost is what? 227,500, subtract the carrying value, 120. Right. If you do that, let's try to calculate that one. Let's try to calculate that one. Right. If you subtract that correctly, you get 107,500. So that's the figure that we are going to put for accumulated depreciation there. So if you come here, it's 107,500. So we are going to say, and we say this figure comes on the debit side. So you've got 107,500. So to find the depreciation for the year for vehicles, this is accumulated depreciation for vehicles account. So to find this X, we are just going to say this one plus this one minus this one. So we are going to say 498 plus 107,500. Then we subtract 366,000. So if you calculate that one, let's try to calculate that one, which is we are going to say 498,000, and then we add 107,500. Then we subtract 366,000. Then we get 239,500. So here we have got 239,500. So this is the depreciation for vehicles. So we are going to add that depreciation 239,500 plus that one for equipment, which is 95,000. So we are going to summarize that one on the answer section for depreciation. So for depreciation here, we are going to say in brackets 95 plus 239, 500. So if you calculate that one correctly, you're supposed to get 334,500. Right, that's enough on depreciation. So remember also there was a disposal. So we would like to see if we have got a loss or a profit on disposal, a loss or a profit on disposal. So basically, let's try to see. Basically, when we are preparing our disposal account, this is our disposal account. The cost price of the non-current asset that has been disposed comes on the debit side. The accumulated depreciation of the assets disposed comes to the credit side. In the cash or bank, the amount received will come on the credit side. Then you compare where do we have the balance. If we have got a lesser balance on the debit side, which means we are going to see the figure here, transfer the figure to the profit and loss. Profit and loss will be here. It will be here, and it will be now debited in the disposal and credited in the profit and loss account. So when it's credited in the profit and loss account, it's an income. But when the credit side has got a smaller figure, it means the balance comes here and it goes to the profit and loss account. And when it goes to the profit and loss account, we are going to debit it in the profit and loss account. And when you debit it, it becomes an expense. So basically, that's what we are going to do here. That's what we are going to do. So what we are going to do here, let's try to see in terms of what we have there, that we are given there. We are given that the cost here is 227,500 is the cost. So this one comes on the debit. Then the accumulated depreciation, we calculated it here, it is 107,500 will come to the credit. And then the amount received, the amount that it was disposed for, it was sold on 30 June for 132, it goes to the credit. So basically, we are going to add this one, 132, we add 120, then we subtract the cost, then we see which one is the bigger side. So when you do that, if you say 132,000, then we add 120,000, you get 252,000. So you see the credit side is a greater side. The credit side is a greater side, so it means the balance is on the debit. So this one is going to be credited in the profit and loss, so it's income. So basically, let's try to summarize the working there. 227,500. You can summarize it in the answer section. So this one we said is going to be profit on disposal. Profit on disposal. And we are saying with the cost price. The cost price that we have for that non-current asset is 227,500. But it's a smaller figure. So let's start by the credit side where we have 107,500. We add the amount received. This one is the accumulated depreciation. Then the amount received was 120,000. Sorry, it was 132,000. Then we subtract the cost, which is 227,500. Then we can just check our figures for accumulated depreciation. We have 107,500 there. Yes, 107,500 is the accumulated depreciation that we found there. So that's correct. So if you do that correctly, there we are supposed to get the profit on disposal. The profit on disposal there. is 12,000. And we said this is income, so we show it in brackets. Remember, all income, we are showing it in brackets. So we go down again. After profit on sale of vehicles, we now add, we are supposed to add inventory at the beginning, then we less inventory at the end. And then we do the opposite for trade payables. For trade payables, we are going to less trade payables at the beginning, and then we add trade payables at the end. So let's start by inventory. We add inventory at the beginning. Inventory at the beginning, we have, let's check the figures that we have there. Let's try to see in the list of balances. We've got inventory here. These are the figures for inventory. We have got, this one is the beginning, 181,000, and this one 244,000 is for the end. So we are adding 181,000, then we subtract 244,000. So let's go back. So at the beginning, we have 181,000. Then we less inventory at the end. And the inventory at the end, we saw it there is 244. We're subtracting it. So the same thing that we are going to do we are going to make an adjustment again for trade payables. Right, for trade payables, we are now doing the opposite. We are saying we add now this one, which is at the end. So basically, you can say add trade payables at the end. And then we less trade payables at the beginning. So here we've got our lines going down. Right. Let's check the balances for trade payables at the beginning and end. Right. Trade payables is here. We are seeing at the beginning we've got 112,000. At the end we've got 140,000. So trade payables at the beginning we've got 112. And we are less, and then we are adding the other 140,000. So that is the figure at the end of our calculation there. And the figure that we are going to get there is the figure for cash paid to suppliers and employees. So if you add starting from the top there, so basically what we are going to do there, we are going to start here on 3,860,500 to add 1,200 to add 1,665,000. So 166,500. Then we subtract 2,250. We add 334,500. Then we subtract 12,000. We add 181,000 to subtract 244,000. We add 14,000 to subtract 112,000. So the answer that we are supposed to get there is 3,363,500 and we are going to get a negative figure. Right. This is the figure that we are going to put there in the cash flow statement. So we have finished preparing the notes. Now we go to the cash flow statement. Right. On the cash flow statement now, the cash paid to suppliers is the figure that we calculated there. The cash paid to suppliers is the figure that we calculated there, and we got 3 million. 363,550. And we found it as a negative figure. Found it as a negative figure. Right. So we now add these ones. That is, we are now adding. The. Let's try to see there. We are now adding these ones. We've got 4,227,500 is our cash received. Right. So you now say 4,227,500. Then you subtract 3,363,550. And when you do that, here you're supposed to get 863,950. And the figure that we are getting here is cash generated from operations. Cash generated from operations. Cash generated from operations is 863,950. Then beneath that now, we are going to adjust for interest expense, interest received, and then also drawings, we adjust it. So here we've got interest expense that we are going to adjust, interest expense. And then we have also interest received. Remember these figures, we adjusted them again. Interest received. And then we also adjust for drawings. We also adjust for drawings there. Right. So here we also have drawings. Right. Let's start by interest expense. Let's go back to check the figure for interest expense. Let's go down to check it down there. Right. Interest expense, we have 1,200 plus 166,500. Both of them, they are interest. This is interest on bank overdraft, and then we've got interest on mortgage board. So we are going to add them and get the total for interest there. So on our interest, we are going to say in brackets 1,200. Then we add the other one, which is 166,500. Then if you add the two, you get 167. 167,700. And this is a payment. So remember in the cash flow, statement of cash flow, we are showing movement of cash in and out of the business. So whenever cash is moving out, we show it as a negative figure in the cash flow statement. And then when we have cash getting into the business, it's a positive. So show it there as a positive figure. So this one is a payment. So we show it as a negative figure. Then we go to interest received now is the one that we now show as a positive. Remember, we calculated this one. We calculated this one there as interest on fixed deposit. If you still remember, let's go up there to check it. We calculated it. Sorry, it's on the notes. It's on the notes there. If you check in our notes, we calculated interest received and we calculated it as 2,250. When you say 18% of 25,000, then we multiplied by 6/12 for the month that it stayed, and we got 2,250. Then we also have drawings. So for drawings, we are going to check again in the question what amount do we have for drawings. Drawings. If you come here, remember the current year is 2021, so the drawings that we have for 2021 is 150,000. So this is the drawings that we are going to put there. So for drawings, we have 150. And remember, when there are drawings, money is going outside the business. So this is shown as a negative figure. Drawings, generally, they are resources that are taken by the owner of the business for personal use. So money is getting out. So we saw it as a negative figure. So those are the adjustments that we have in terms of operating activities. Right. So we now add, this one is a positive 863,950. We subtract 167,700. We add 2,250. We subtract 150,000. Then when you do that, we are going to get a positive figure of 548,500. So remember, we have got our cash flow from operating activities here. So that's where we're going to put the answer there, which is 548,500. So on that one, now we move on to the next, from cash flow from operating activities. We move on to the next category, which is the cash flow from investing activities. Remember, in the cash flow statement, we adjust them with 3 different types of activities. We've got operating activities, investing activities, then we've got also financing activities. So from operating, we go to investing activities. So we are just going to say cash flow from investing activities. Right. Cash flow from investing activities, the total, we are going to put it here. So we can leave that one. Then we list the investing activities that we have. So the investing activities that we have got additions, to land and buildings. Right. Let's go and check there in terms of the balance that we are given of land and buildings. Right. If you go to the list of balance that we have got a section for land and buildings that we have there. They're just telling us property, plant, and equipment. So we go to the next page, to the notes. Right here, we have got land and buildings here. We are told that for this is what 2020. For 2020 land and buildings, we had 1 million worth of land and buildings. Then 2021, they increased. 2021, they increased to 1,600,000. You are seeing this figure, 1,600,000. So, and we are not told in the question if we had any of the land and buildings that were disposed. There is not land and buildings that were disposed, but we are seeing an increase there, which means we purchased some. So the value of the land and buildings that we purchased, we are just going to say 1,600,000 minus 1 million, then we get 600,000. So that's the one that we purchased. So we can just summarize that working there for land and buildings. These are additions. So we are just going to say 1,600,000, then we subtract 1 million. And remember, here we are purchasing. So when we are purchasing, money is going outside the business, so it's a outflow. So show it as a negative figure. Then we also have additions. We also have additions of equipment. Right, we go again to the question to find out about additions. Right, to find out what amount was added, we try to find out if we are going to have a differential in terms of the amount. Remember, we have the cost price at the beginning of the year, which is of equipment, which is 325,000. Which is 325,000. thousand, and then at the end of the year we had 410,000. And we are in the question, we are not told about any equipment which was disposed. So it means this increase represents an increase, a purchase of equipment. So to find that purchase, we're just going to say 410,000 minus 325,000. So we can go back there now and just summarize the working that we have there. Then we are just going to say in brackets, maybe here we can just summarize there in terms of, we say 410,000. Then we subtract 325,000. Right. If you do that, we get 85,000. And remember, this is a purchase, so outflow negative. Then we also have additions to vehicles. Additions to vehicles. Right, we go to the question to try to find out how we can find these additions to vehicles. Remember, we are given that so to find the amount of additions, you can use the formula there, because there now we cannot do it the same that we did on equipment, because on equipment we applied that formula that we just said, the recent balance of of cost price of equipment, then we subtracted the previous balance of cost price of equipment. Here we're going to do that because there's a disposal that took place here on 30 June 2021. So we need to see, we need to put that disposal in the formula. So basically we say opening balance of the cost price, then we add the purchase at cost, then we subtract disposal at cost, and you get the closing balance at cost. You see now. So what we are going to do now, we are going to see that our opening balance at cost is what of vehicles is 731,000. 731,000. Then we add the purchases, is the one that we want to find out. Then the disposal at cost, we are told that is 227,500. 227,500. And then the closing balance at cost is the one that we are given here, 1,052,000. So if you make P the salary with formula there for purchase, we are going to say 1,052,000. We add this one comes here, becomes a positive. This one comes here, becomes a negative. So we can go and summarize that working there. Right, we are now here. We can say 1,052,000. We add 227,500, and then we subtract 731,000. So when you get that, when you calculate that, you are supposed to get 548,500. Remember, this is a purchase, so we saw it in brackets. And also we have got proceeds from sale of vehicles, the one that was disposed. How much did we receive? Proceeds from sale of vehicles. So this one, you can find it in the question there again, in that explanation there. We are told that it was sold for 132,000. So 132,000 is the one that we received. So we are going to put that one, 132. So this one we are receiving, so we show it as a credit. Right. Then we also look at investment. There's an investment there. There's an increase in investments. Remember, we've got a fixed deposit. So that fixed deposit represents an investment. So let's go and check what increase do we have there. We go to the list of balances again. in the question, this financial assets represents an investment. Remember, we had nothing at the beginning of the year, but now we have got 25,000. So 25,000. So whenever there's an increase in the investment of financial assets, we represent it as an outflow. It's a negative figure. So we are going to put that 25,000 as a negative figure. So here we have 25,000. 25,000 is a negative figure. Right, so we can try to remove this, that we finish the remaining part. Right, from there now we can try to add there to get the total. Right, we close here and here and get the total for investing activities. So what we are going to do here, we're going to say negative 600 minus 18,000 minus 514,500. Then we add 132,000. We say minus again 25,000. So the answer that we are supposed to get there, right, is the investing activity that we are going to put here. We are supposed to get a negative 1,126,500. It's a negative figure. So that's what we have. So at the end there now, we are going to get we are now on the financing activities. Let's try to input the figures for financing activities. Right now, so we go to cash flow from financing activities. They are here. So we are going to the net figure. We are going to put it here. So now we are on capital contribution. So we go to our question to find the capital contribution. Remember the capital contribution. We are going to get it on the equity section. Because capital is there are resources or money that has been introduced by the owner of the business to run that business. So we try to find out here where we have got that section. That's statement of changes in owner's equity. So the owner's equity is the capital. So that's where we're going to get that balance for capital contribution. So basically, by the end of at the beginning, for last year, previous year, we had a balance of owner's equity of 1,029,000. But when we started for the current year, it was now 1,087,000. So that's where we are going to get the capital contribution. We are just going to say this one that we have 1,087,000. Then you subtract 1,029,000. So this one and this one minus this one, then you get the figure for capital contribution. So when you do that, you're supposed to get 58,000. So when you come here, we are going to put our 58,000. And then also we have got an increase in mortgage bonds, which we are going to find out where we can find it. Increase in mortgage bonds. So if you go back to our question, on the list of balances, mortgage bond is here. At the beginning of the year, it was 800,000. Now it's 1,300,000. So basically, we are saying 1,300,000 minus 800,000. When you do that, you get 500,000. So this is the one that we are going to put on that one. So it means here we have 500,000. Right. So both of them, we are showing them as positives because on capital contribution, 58,000. So it's an inflow for the business because this money is being introduced into the business. Then when you take a mortgage bond, money, we are receiving money as a business. So we are showing them as positive. So that's all we have on financing activities. Then we add to get the total obviously the total is going to be a positive, which is 558. We have 558,000. Right. So that's what we have. Then we have the net change now. The net change in cash and cash equivalents. Here we have got net change in cash and cash equivalents. Net change in cash and cash equivalents. Right. Net change in cash and cash equivalents. So to get that figure, we are just going to use the figures that we got for both. Because we remember we started from operating, we found a net figure. Then also for investing, a net figure. Then for financing, lastly, we also got a net figure. So we start from the one that we had for operating. For operating, we got 548,500. Then we subtract 1,126,500. And then we the third one is from financing. Then we add 558,000. So then we get the net figure now. Right. So if you do that, that's when we get net change in cash and cash equivalents. And the figure that we're supposed to get there is a negative figure, 20,000. And show it in brackets. And then we are supposed to add cash and cash equivalents at the beginning of the year. Cash and cash equivalents at the beginning. At the beginning of the year. So we'll go back to check what do we have at the beginning of the year in terms of cash and cash equivalents in the list of balances that we have. So if you come here, you see that cash and cash equivalents at the beginning of the year, we've got 15,000 under current assets. If it's under current assets, the positive figure. Then we check under current liabilities if we have got an overdraft. If there's an overdraft, subtract it from 15,000 to get the net balance there. So here we are seeing that at the beginning there's no overdraft. So we are just going to take 15,000 and put it there. So 15,000. So here we are going to have 15,000 is a positive figure. Then when we say this one, net change in cash and cash equivalents plus cash and cash equivalents at the beginning of the year, you get the figure for cash and cash equivalents at the end of the year. But here we've got a negative figure at the beginning, so we're going to say negative 20,000 plus 15,000. Then you get a negative 5,000. Then the figure that we get there is now net cash and cash equivalents at the end of the year. Net change cash and cash equivalents. At the end of the year. So this figure that we get here is the final figure in the statement of cash flow. So that is what we have, guys. So this figure, negative 5,000, should be the same with the figure of the balances that we are given. So this negative 5,000, if you come here in the list of balances, we should see it there is negative 5,000. You see now cash and cash equivalents at the end, we have got 1,000, which is a positive under current assets. So you have got plus 1,000 as a positive. Then we also have a bank overdraft, which is a negative, so minus 6,000. Then when we say 1,000 minus 6,000, we get negative 5,000, which is negative 5,000. So this is the same figure that we got as a closing balance in the statement of cash flow. So when we have done this, you know that you have done it correctly. So that is what we have, guys. Keep in touch. Please subscribe for more videos as we prepare for exam. With that, I am out.